Hello and welcome. You're watching KYC. We're today going to talk about Hindustan Zinc, and first off, I'm going to talk about why. Hindustan Zinc has literally supplies 75% of India's zinc production and caters to nearly 75% of India's zinc needs. So in that sense, it's a critical company with a very high free cash flow. It does free cash flow of roughly 15,000 crore, and there could be an upside bias to this. Why would that be so? Two reasons. One, you're expecting cost of production of zinc to continue to compress. They've done that in FY25. Likely, it's possible that they could do it in FY26 and beyond as well, which could healthily add to the free cash flow number that Hindustan Zinc does. The second reason is zinc prices. Of course, that element is a little more variable, a little more outside Hindustan Zinc's possible control, but it's the world's second largest zinc producer, and therefore, in that sense, controls some bit of that. So those two positive tailwinds could well lend a push to the numbers for Hindustan Zinc going forward. Last 3 to 4 year numbers, etc., we'll of course discuss, but let's first talk about the company. And let me bring on board Mihika Barve as well, because she's going to help me do that. Yeah. Welcome, Mihika. Good morning. So I'm going to first start off, Mihika, by probably breaking down the company. It's engaged in mining and smelting of zinc, lead, and silver. It's the world's largest integrated zinc producer with the lowest cost of production. 77% of domestic primary zinc market share is directly owned, controlled by Hindustan Zinc, and it's India's only integrated and listed silver player. So some of those factors. Mihika, what about commodity prices? What can you tell us about that vis-a-vis Hindustan Zinc?
Yeah. So when you look at a Hindustan Zinc, its earnings and thereby its profitability is dependent on three factors. The first factor is your commodity prices, and the potential earnings depend on how the movement in zinc and lead prices as well as silver prices move in. Now, FY25 earnings were supported by a 16% year-on-year rise in the zinc prices, and the company had a strong set of numbers for the same. And the company does expect resilient prices in FY26 despite globally a zinc and lead surplus vis-a-vis the demand. They do expect stable pricing for the next 3 to 6 months. Now, FY25 average price for zinc was $2,800 per MT. The expected price as per the company stands at $2,850. Now, this is obviously the average price that they expect in FY26. There could be volatility during the financial year. For lead, from 2013 odd levels to $2,025 per MT is what they're expecting. Now, 10% rise to the commodity prices was when you compare to the FY25 average. For zinc, it leads to a 1,900 to 2,000 crore positive impact on EBITDA. For something like lead, it leads to almost 300 crore EBITDA addition, and for silver the range is between 550 to 575. The next thing that we need to look at when you have your you have your commodity prices stable, Harsh, is production, how much they're producing. Now, year-on-year growth for mined metal, it's been a very steady uptick, but they do have certain small growth projects into stream, and their target for FY26 stands at 1,125 kiloton per annum. The same thing for refined metal stands at 1,100 kiloton per annum, and for silver, which is a byproduct of all their mines, and they are, and all depends on the kind of grades of silver you're getting at the mines, is expected to see a further uptick in the range of 700 to 710 metric tons. And lastly, you have to look at, like Harsh mentioned, cost of production. FY25 zinc cost of production stood at a 4-year low, and the company has reduced their cost of production by $300 per ton if you look at their peak level, and their FY25 zinc cost of production stood at $1,052 per ton. This is lower than what we saw in FY24, and their target ranges between $1,025 to $1,050 per ton in FY26, but it may be lower if the company has more renewable power in their power mix as per management. Lastly, a 5% fall in the zinc cost of production has around $425 to $450 odd crores of benefits for the company's EBITDA, thereby helping its profitability. So Harsh, when you look at what the earnings and the profits of Hindustan Zinc matter on, these three factors are the ones that you need to watch out for.
Perfect. And you know, maybe to contextualize this a little bit more, we spoke about how Hindustan Zinc's EBITDA is roughly 15,000 crore. If all of these factors were to play out, you could likely see at the same volume level an EBITDA rise of 20% this year, which is FY25 versus FY26. So keep that in mind. Of course, this is subject to all of those factors playing out. 10% rise in commodity prices, 5% fall in zinc cost of production. And there are large downside risks to both of those playing out. So something to keep in mind. But if it were to play out, it could be a large positive as well. So something again to keep in mind as we analyze Hindustan Zinc. Let's talk about the factors that we'll look out and we'll try and assess as we break this company down. We look at income statement, balance sheet, cash flow, as well as return ratios. We'll also look at shareholding, street cred, street coverage, and valuations. So we'll look at those 8. Let me start off with the income statement. The revenue FY25 versus FY24 has gone up 18%, but the 3-year CAGR is just 6%. A lot of this in terms of top line, just for context, is determined by pricing and volume, both of those. So you will see plenty of variability with regard to the top line number. And let me try and demonstrate this. So FY23, the top line number was 34,000 crore rupees. FY24 was 29,000 crore rupees. And FY25 went back to 34,000 crore rupees. Just for context as to how the variation is. In fact, even FY22 was around 29,500 crore rupees. So that variability largely driven by prices, by commodity prices, and very little by volumes, because the kind of inch up we've seen in volumes has been steady, but just maybe 2-3% inch up with regard to volumes. So not so much volume growth, more value growth is what you have to look for in the top line, and that's what we've seen. In terms of EBITDA as well, there's a clear flow through. So your EBITDA margins are quite healthy at around 56% odd, but they tend to fall as well. So we've seen that EBITDA margins can fall if there is pressure with regard to cost of production, and therefore you will see that variability even with regard to EBITDA margin, as you can see on your screen. So something to take care of. But again, over the year-over-year period, we've seen a solid EBITDA growth. From the 19,000 crore number, EBITDA has inched, or rather from the 15,000 odd crore number, it's inched up towards 19,000 crore. And another 3 to 3,500 crore could lead to an expansion of around 15% odd to that EBITDA number, if that were to translate, of course, the 3,500 crore that we spoke about in terms of lowering with regard to cost of production and increase in terms of commodity zinc prices globally. So you could see some of those variables happen. Now let me try and go a little more granular here, because on the 19,000 crore EBITDA, 2 costs majorly are incurred. One is an interest expense of roughly 1,000 odd crore, and second is a depreciation expense, which is a non-cash expense of around 3,500 crore. That's how you land at a profit before tax, roughly, of around 13,500 crore, and thereafter the profit after tax is roughly 10,300 odd crore, which has gone up well when you're looking at it on a YOY basis. It's also the increase in the interest expense and the increase in the depreciation which has led, or rather increased the net profit a little bit more. So that's how it's played out, at least the profit after tax. Let's now look at the balance sheet. Now in terms of the balance sheet as well, fairly healthy in terms of capitalization, but what we've seen is a sharp increase with regard to debt. So FY22, the debt was sub 3,000 crore, even on a console level, including short-term liabilities, etc., was roughly around 10,000 odd crore. Now, with the standalone borrowing number is roughly 11,000 crore. and with other liabilities. It's coming.
But it's key to know that FY25, the company was full in 2 growth projects.
Yeah.
And they were investing heavily. And
Correct.
these will be commissioning in FY26, one in Q1, one in Q4. So that's where you're seeing an uptick in debt.
Perfect. So that's the reason why there's an uptick, but there's an uptick nonetheless. And therefore, you've seen interest cost also rise gradually over the last 2 to 3 years. So something to keep in mind. But when you're looking at the overall market capitalization of the company, and let's try and contextualize this a little bit more. So you've got 10,000 crore of debt, but the profit after tax of the company is 10,000 crore. So in that sense, it's well protected. Second is the EBITDA of the company is roughly 18 to 19,000 crore. 15,000 crore over the last maybe 3-4 years if I take the average. 18,900 odd crore if you're looking at the current year. And therefore, it's very, very well covered from an interest cost perspective. There's no concern there. So your balance sheet seems to be well protected. For a 2 lakh crore market cap company to have an 11,000 crore debt is okay. But when you're looking at the debt to equity, it's even Steven, it's almost 1:1. And therefore, slightly on the elevated side, the debt, but no concern per se because of all of the factors that are highlighted. Profitability with regard to market capitalization, when we compare it, the debt looks fairly okay. Also, something to note that a lot of the capital of the company is legacy capital, something that has been invested over the last 20-25 years. And therefore, those costs and the costs today don't really align. And we'll see that in the return ratios. But that's how really the balance sheet is panning out. No real concern on with regard to the balance sheet. Now, let's look at the cash flow. And that's where the position starts to change. And you'll see that improvement. The cash flow has roughly been 14 to 15,000 odd crore over the last 3 years. 13,500 crore in FY24. And now 15,000 crore, fairly steady, right? If you just take the 19,000 crore EBITDA, reduce the tax and maybe an element or two of interest, then that's where you're landing up in terms of cash flow. So fairly healthy in that sense, but there's no inch up. There's no growth which is visible in the cash flow at this point. So again, something to be kept in mind. We'll give this a neutral with regard to the cash flow, Mihika. But at least these are the 3 parameters that we've looked at. Mihika, you want to take us through return ratios?
Yeah. Interesting set of numbers here because you've seen the return of equity of this company in FY25 be 72.6%, and it's been a steady growth from FY23 from 44% to 55% to 72%. But when you talk about return on equity, you need to know that they have certain assets that have been on their books for years and they were capitalized a while back. Even if you look at the return on capital employed, which basically kind of helps you gauge how much profit or cash the company has been generating on the capital that it has been investing. So generally a higher ROCE does suggest that a company is better generating profits from the capital that it is infusing into the company. Return on capital employed has been growing from 39% in FY23 to 43% in FY24 and then to FY25 at 52%. Key to know that FY25 the company did have some growth projects going on, and the capitalization for those would come once they have been commissioned in this financial year, which is FY26. And then you have return on assets, which has seen a steady decline from 26% to 22% to 20%. However, it's key to note that Hindustan Zinc has been operating for a long time and it has dated assets. So when the depreciation in certain fixed assets become older, the kind of efficiency you're going to get from certain assets or even from certain of the mines that we've been investing, which is what we've been seeing in the company's silver mines, this tends to kind of steady slowly, and then it depends on the company when they want to get and explore new assets and when the returns from those newly coming in assets do come on the books. But it's still a thumbs up on us for the key ratios of the company because they stand high and we've seen a good growth over the past few years. Next up, I also want to talk about the shareholding pattern. Now, they have a strong promoter holding. It's Vedanta, which is the promoter and Hindustan Zinc is a subsidiary company of Vedanta. Vedanta has sold some stake over the years, 64% to 63% when you look at from March 23 to March 25, but it's a strong ownership nonetheless. You also have a stake of the government of India in something like an Hindustan Zinc, which has been steady in the 27 to 29% range. And it's actually domestic institutional interest that has grown from 2.95% at the end of FY23 to over 4% in FY25. So you've seen that traction coming in, and the traction is not only domestic, it is also from foreign institutional investors, like you can see on your screen, 0.8% as of the end of FY23, and now it stands over 1.4%. And then when you look at individual retail participation, it is fairly small when you compare to all the other shareholders, but you've seen that grow as well from 1.8% to 3.1% over the last 2 years. So it's a thumbs up on the shareholding pattern. And then I want to talk about the street cred. Now, in terms of the performance of the company in the past, the stock is up over 2% today, but in the past 1 month, it's down about 4%. If you look at even the year-to-date performance, it's fairly flat. But it's key to note that it's not been a steady downtick when you look at the year-to-date performance. You've seen a volatile stock movement. Like, for example, the entire month of March, the stock was gaining, but it was after April 1st week that we saw the stock declining. And the one-year gains, it's 4%. If you count today's gain, the stock is up 7%. But yeah, it's key to note that the stock is down around 40% from its peak levels. It's, even its year range stood at around 800. Life high actually stood around 800 odd levels. Currently, the stock is trading around 455. But if you look at a long-term period, the stock has given returns. Your 5-year period is at 154%. That means the stock has doubled, and this is despite it being 40% lower from its highest point. So we've given a neutral rating on the street credential for this counter. But Harsh, how is the street viewing the stock?
Well, yeah, so we have 5 buys, 3 sells, 7 holds, so fairly balanced in that sense. The return potential is extremely muted on this one. So clearly not a thumbs up, but we'll give it a neutral, flattish kind of return expectation. But again, a decent dividend yield. It gives around 7% in terms of dividends annually. And therefore, maybe something to look out for, that while the return potential may be muted, you might still make a decent amount in terms of dividend. And that also brings me to valuations, right? The current price to earnings is roughly 18.5 times. The 5-year average price to earnings has been around 23 times. So slightly cheaper on that note, despite the return potential being muted as per analyst expectations. Again, the dividend yield at around 7% is slightly on the lower side, given the fact that over the last few years, we've seen very, very heavy dividend distribution. Now, in terms of, I'm just talking from FY21 to FY24, in those 3 years, FY22, FY23, FY24, and FY21, the company has given a dividend of over 50,000 crores cumulatively. This is a 2 lakh crore market cap company, which has given out nearly 50,000 crore plus of dividend distribution.
But it's key to know that most of it is going to the promoter and the government of India.
So if that is the requirement of the promoter and of the government of India, then the shareholders are inadvertently beneficiaries of that, Mihika. And therefore, my view is that the free cash flow which comes through will in any case flow through shareholders, whether you are Vedanta as the shareholder or government of India.
And if you see, we were discussing earlier, this last 10 years, 6 years, the payout ratio was above 100%. So that's something to look at.
Absolutely. So maybe that also to be kept in mind, that pretty much all of the EBITDA coming in is going out in dividend payments, which is something to keep in mind. In fact, the payout ratio is also extremely high, as Mihika obviously highlighted. So again, something to keep in mind. So we're going to give this a neutral as well in terms of valuations, just comparing it to 5-year averages, because there's not too many companies in the space, Mihika, which has a 75% market share in a commodity play like zinc, and therefore it's an interesting one. Let's take our final ratings and cumulatively let's stack it up. The income statement, no real growth. Balance sheet, fairly placed because debt is low in comparative terms. Otherwise, debt to equity is 1:1. If you remember, Cash flow also no growth there, and therefore we've given it a neutral, but very strong cash flow overall. Whatever is coming in the P&L is going straight into the cash flow statement and going out as dividend. Return ratios is a thumbs up because all of the legacy equity is now giving decent returns with regard to how it's playing out and will continue to do so. I'm not sure how much on incremental investment, Mika, they're going to be making with regard to the return ratios. So something maybe we need to keep in mind. Shareholding is a thumbs up, street cred is neutral, street coverage is neutral, and valuations are neutral. That's how it stacks up. Let's go though, dip into that conversation with Arun Misra, who's the CEO and whole-time director at Hindustan Zinc. Mika spoke to him. Here's what he had to say about the company's play on pricing as well as capex guidance going forward, because those are going to be variables which could alter cash flow both from a dividend standpoint as well as from an EBITDA standpoint, and alter valuations as well. So listen in. Interesting conversation.
First of all, congratulations for a strong Q4. Let me start off this interview by asking your view on how the quarter went by.
No, the quarter, as we have demonstrated, we have got more than 1.2 million ton mined metal production capability. We have remained almost at a quarter 3 level of finished metal production, but year on year we have scored a good. Overall, if you look at cost, we have produced in the quarter 4 $994 per ton, one of the lowest ever cost that we could produce. Of course, it is for quarter 4 because of the high grade of metal and all that, we could get such a lovely cost. So overall in the year, we have almost close to our guidance as far as mined metal is concerned. We are almost same as on the cost guidance is concerned, gives us a lot of satisfaction. And of course, nothing is more satisfying than generating a profit after tax of 10,353 crores, 33% increase year on year, which should make everyone happy.
Next, I want to focus on pricing. There's a lot of global uncertainty and domestic factors at play. How are you viewing pricing for zinc, lead and silver to be in the first half of FY26?
See, the first part is the uncertainty. It was more uncertain maybe a week back. Slowly it's becoming certain that the tariff trade war does not benefit anyone. That realization is sinking in, and I am sure the whole thing will be resolved in 3 months to 6 months time. So hence my prediction is next 3 to 6 months, don't expect much movement in the price. It may remain range bound between $2,600 to $2,750 per ton. But once everything re-establishes, we know now the likely growth in GDP, because in many places GDP has shrunk. So we'll have to look at where all the GDP will expand, and that I can expect only increase in prices of quarter 4 of this fiscal. That means Jan to March of next year, not before that.
So with no significant change in pricing for the next 3 to 6 months, how is demand looking like? What cues have you been seeing so far in quarter 1 of FY26?
See, right now, the US consumes about 700 KT out of the 12 million tons of production globe does. In spite of tariffs, supposing the demand shrinks in US, but it cannot become zero, it remains as say 350, 400 KT. So all that remains is imbalance of 400 KT metal to be shipped from one geography, which is Canada, Western Europe, to rest of the world. So that's not going to upset the equation so much. So all producers will first make an attempt to satisfy their local market. And that will not allow them to increase the prices beyond the range. So everybody will stick to this number and try to push as much of sales in the nearby vicinity as possible. The supply chain is most uncertain now. So after 6 months or so, I guess the supply chain will be streamlined, and then you can expect slowly the prices to correct going into January to March of next year, maybe around $3,000 per ton.
Got it, sir. So amid all of this, do you expect muted realizations for your volumes in H1 of FY26?
See, we are a domestic driven company, and the prices in India will remain very stable. Domestic demand will remain to be high. We are the only producer, so we have to manage our cost even better, because at 27, 28 and 26.50 to 27, we need to ensure that we have a further cut of $50 to $75 per ton in our cost. That is visible to us how to do that, both in terms of increasing renewable power mix in our operations, also managing the grade of ore that we mine. We will do all the actions necessary and ensure that we remain in that cost leverage of about $1,000 to $1,052. so that we can keep getting this benefit.
I'm glad you mentioned your cost of production. FY25 saw zinc cost of production at a 4-year low. What's your target for FY26 and what is going to help you take it there?
No, we are still keeping it at 1050 only, but if our renewable power mix increases sharply, we could achieve up to 15% in quarter 4, total 13% this year. Next year, we want to exit at 30%, but if we are able to bring this project faster, we will get a faster cut in cost. At the same time, if we can really strike a good amount of silver in our SK mine, of course, it will impact our earnings and profitability.
Sir, I also want to ask about silver. Your FY26 guidance shows a 3 to 5% uptick in mined as well as refined metal. But silver growth is rather muted. Can we expect an uptick in this segment soon?
There are two things. One, silver is a byproduct. It depends upon the grade of ore that we mine, as well as what is the production strategy. So this year we have taken entire 12 months. We will be running in zinc plus lead mode that will focus on maximizing metal production, and whatever silver we get as a result of it, we should be happy with that. And to that account, I won't call it a muted number, as a more realistic number.
So now coming to your growth projects, the 160 kiloton per annum roster is set to commission in Q1 of FY26. What kind of benefits will this be bringing into the company?
It will straightway add another 45 KT of production. So like last year we finished at 1052, we should be doing 1.1 million ton metal next year.
And I also want to talk about the 510 kiloton per annum fertilizer plant that is set to commission by the end of FY26. Does the company, it mentions that DAP fertilizers will fetch the right margins. What kind of revenue contribution and margins can we expect?
We are not looking to fertilizer business to compete with zinc business, right? Fertilizer business is more from one de-risking our operation, because we are handling huge amount of 98% strong concentrated sulfuric acid. And so we are always under the pressure of dispose it off and get it sold and all that. Of course, it brings us some money. As long as fertilizer brings us profit over and above what we used to make with acid, we are happy. This is more for catering to the farmers in Rajasthan and western part of Orissa, western part of India, where they are forced to buy imported DAP. If we can supply them DAP and then help them to grow their product well, and we get a fair margin, not an exceptional margin, we are happy with that. We are not really factoring in a large profit from fertilizer business. So
coming to CAPEX, what's the overall FY26 CAPEX guidance and how will it be allocated?
Absolutely. So what we have done, the currently guidance is very minimal, $225 to $50 million is minimal, which is tapering of the earlier growth projects, be it fertilizer, be it roaster, and some amount of replacement equipment, debottlenecking projects, things like that. But wait for a month or so, then we should make big announcement on our next growth plan. And that would be the real capex. So it is not in the guidance, but it will get added later on.
Lastly, sir, I know you can't give exact details on these new announcements coming in, but what areas will these growth projects be focusing on?
Another 1 million ton metal. Similarly, so roughly about 0.8 million ton of additional zinc, 0.2 million ton of additional lead, another 600, 700 tons of silver. It's like doubling of Hindustan Zinc. So we should do that.
Okay, so that's an engaging conversation with the management of Hindustan Zinc. But for the moment, from Mika, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.